Hello, everybody. I'm going to have a quick look at how to apply technical analysis to the world of trading, abbreviating technical analysis as TA. So it's my job as a trader to come up with trading strategies to make an edge. I'm here to make money. That's my job. And how do I do this? Well, actually get ideas from all over the place: fundamental analysis, quantitative, gaming theory, behavioral, pure technical analysis. I trade them algorithmically and as systematically as possible, but mostly the execution of my trading, the management of the trading, even down to the portfolios, are done using technical analysis. But I've noticed over the last 5 to 10 years that trading has evolved quite a lot. And today it seems to be a lot more about big data. And what does that mean? Well, people are looking for anomalies, price patterns, behaviors over large data sets. Now, most people think technical analysis is just about price, but I can tell you it's not. If you can turn any data series, set into a model, whether that be economic data, company results, weather, inventories, storage, for example, in commodities, volatility, you can measure, analyze that. You can use technical analysis alongside that to, like I say, find these anomalies, patterns, behaviors, etc. And that can allow you to create effective trading strategies around a point of view. Now, why do I use technical analysis? Because it's a massive part of my process. I think it's excellent for trade timing. That's getting in and out of the trade. Even if you're a fundamental trader, there's an optimal in and out. Risk and trade management, that's like risk rewards of the trade, capturing repeatable patterns and trends. It's a lot easier to see. You can use different time horizons. You could be a fast trader in the 1 minute, 2 minute, 5 minute charts to a slower trader, daily, weekly charts, or some charts take away time altogether and just focus on price action. It's fabulous for strategy design and back testing, and some other factors you might not consider. Also very good for performance measurement and analysis and portfolio management. But the overall goal, because technical analysis can be quite subjective and trading subjective, I try to make it as objective as possible. And because of that, I've come up with some highly effective trading strategies using technical analysis. Now, for example, I ran a Renko chart strategy, pure technical analysis, added in a few Western technical analysis indicators. For 1 year, it returned 300% on investment with a Sharpe ratio of about 6. Pure technical analysis, so I know this stuff works. And I've got other strategies that use, variants of, different inputs, fundamental, behavioral, like I said earlier. But that's just an example of how I use technical analysis. So we're going to look at a few practical examples. Japanese yen here, recently seen a breakout in the price. See that ascending triangle? What you would do, basic rules of technical analysis, is take the A and B, add it on to the breakout, becomes C and D. That's your price target. You enter on the break. Axel said some people wait for that pullback. I'm more aggressive, so I go in on the break. Stop loss just under the triangle pattern. Gives you a risk return of 2.23 to 1. So not a bad trade, but trading the price patterns on their own, to me, is unreliable. You have to strengthen that predictive nature, put the odds more on your side. And also, when using technical analysis, there's a rule called Colinearity. That means don't put indicators together that are based off the same input. So, for example, MACD and RSI are both on the close. I put together other variables, sentiment, volatility, volume, that sort of thing. And if they're all adding up to a buy, then you've got the probability, the odds on your side. So here's that same Japanese yen triangle pattern again, but I've added 2 further indicators. The Ichimoku cloud, I've stripped back the main concept. That's that red and green patch just under the price there. If it's above it, the price is bullish, below it's bearish. And at the bottom there, the blue and red lines, that's a directional movement indicator signaling to me the trend. Look for a crossover. Blue's above red, it's a buy. So we've got a buy there. We've got a buy on the cloud setup, and we've got a buy on the breakout triangle. To me, that's more of a certain trade than just using the pattern on its own. Now, another strange thing you might see on the charts is called gaps. What is a gap? Well, it's a shock to the market. It's most notable, you'll probably find in stocks and commodities, sometimes cryptocurrencies, and it could be pre-market orders before, say, the US stock market opens, a political event, a war, a weather event, whatever spikes that price. And these gaps are, so easy to see on the charts. We see in a minute. Normally the bars, the candlesticks will overlap each other. If they don't, then it's quite easily a gap. And it's where no trading has taken place. And a point to note there, like I said, equities, commodities, yes, rare in Forex. If you see it, take note, quite important. So 3 types of gap: breakaway, runaway, and exhaustion. And I'll visualize those for you on this crude chart I drew. Normally on the bottom left there, you'll get a sort of consolidation pattern. The price will break away to what we call the measuring gap. And then the final run up will be this exhaustion gap. You'll get a topping pattern. And that's often called an island reversal, because what then happens is the price then breaks and gaps below and the price comes down. Now, I found an example this week on Leonardo. They are an Italian aerospace defense company. It hasn't happened yet, so it's one for you to maybe follow later. We can see the consolidation pattern. You can see our first gap. We've got the runaway gap, and this bit in between here we can use to measure the expected trend upwards to the exhaustion gap. Now, what happens, we could expect to see that topping pattern, another gap down, and then the price pulling all the way back. So that's just a typical visualization of how to look at gaps. Now, you can use patterns on all different chart types. Remember I said that Renko strategy I use? Well, this is on crude oil futures. It's a Renko chart. It takes away the noise. It makes trends a lot easier to see. Now, Axel showed you a double bottom pattern. This is a double top pattern here, this M. And the white arrow is the height of the pattern. We reflect that down for a potential target area. And you can see where the price action actually stalls and gives us a one-to-one risk reward trade. The stop's just above the highs there. Now, I would be short just on the break. And I've also married in stochastics indicator here. As the price comes up through the 20, that's the exit. So I get out actually right at the bottom. And it's not my actual strategy that made me 300%. I'm going to give my secrets away here, but it's quite close. You can use some really simple, effective technical analysis to make some really powerful trading strategies. Another example, ultra US bond futures. This time it's a short trade. It's a descending wedge pattern. It's the AB again, that height of that triangle, down to the CD is your potential target. Again, the rules of adding on the cloud, the price is below, so it's bearish. The DMI this time red above the blue, so it's bearish. So sell, sell, sell. We go short, hits our target, a month or so later. So another good trade there, just using some basic technical analysis. So finally, when I'm turning it into a strategy, I have the idea around, like I say, fundamental, quantitative, whatever idea it might be. And what I then try and do is get that data, back test it, and using technical analysis, it just makes it so much easier to do that. Putting those inputs in, measuring whether I've got that edge. I'm pulling back quantitative statistical results to see whether my ideas are worth trading. And if I've got that edge, I trade. And then I'm also building all that statistical evidence into my portfolio and risk management of the trades. And that makes your approach more disciplined, more objective, and I think quite more effective. So there you go, a little insight into what I get up to in the world of technical analysis. So yeah, thank you very much.